Welcome to the deep dive. Today, we're really getting into a classic, maybe the classic, Benjamin Graham's The Intelligent Investor.
Hmm.
Our mission really is to pull out that timeless wisdom, give you a kind of shortcut to understanding these core investing ideas.
Yeah,
I mean, when Warren Buffett says it's by far the best book on investing ever written, well, you pay attention, right?
you absolutely do, and it's quite something how a book from what 1949,
Yeah, 49.
how it's still so spot on today, because Graham really nails human psychology and the market basics.
It's things that don't fundamentally change.
Exactly, those things just don't change much. So it's indispensable, really, for anyone serious about investing.
Okay, so let's jump into the big one, value investing. It's the heart of the book. We hear the term, but what did Graham really mean by it? Why is it so foundational?
Well, at its core, value investing for Graham was about buying securities, stocks, bonds when they seem underpriced based on solid analysis,
Yep.
hard
It's
facts.
not just hype.
Right. Definitely not hype. He pushed investors to focus on intrinsic value, the real underlying worth of a business, its assets, its earning power, its future prospects, separate from whatever the market sentiment is that day.
Okay.
And his real stroke of genius here was the concept of a margin of safety.
Margin of safety.
Yeah,
Okay.
it basically means buying at a significant discount to that intrinsic value you calculated. So if you figure a company's worth, say, $100 a share,
Hmm.
you don't buy it at $95. You wait. Maybe you buy it at $70 or even $60 if you can.
So that gap is your protection.
Precisely.
Yep.
That $30 or $40 gap, that's your margin of safety. It protects you if your analysis was a bit off or if, the market just tanks unexpectedly. It's a cushion against error and panic. It lets you avoid those emotional decisions.
That makes a lot of sense, that buffer. Now, Graham also split investors into two main types, didn't he?
He did, yes.
Yeah.
And it's quite useful, I think, for self-reflection.
So what are they? Listeners might see themselves here.
Okay, so first you have the defensive investor. This person prioritizes safety above all else. They want minimal effort, minimal fuss. Think diversification, index funds, maybe some really solid blue chip stocks. It's a more passive approach.
Set it and forget it, almost.
Sort of, yeah.
Yeah.
Then you have the enterprising investor. This is someone who's willing to put in the work, a lot more work.
Okay.
They're actively researching, digging deep, looking for those specific companies that are genuinely undervalued, maybe missed by the wider market.
And Graham didn't say one was better.
No, not at all. That's the key. He was very clear, neither is superior. What is crucial is figuring out honestly which camp you belong in based on your time, your interest, your actual skill level. And then this is important, sticking to it consistently. Don't try to be an enterprising investor if you only have the time or inclination to be defensive.
Right. Consistency is key. Okay, let's talk about Mr. Market. This is such a brilliant metaphor. Can you unpack that for us?
Ah, yes, Mr. Market. It's fantastic. So Graham asks you to imagine you have a business partner, Mr. Market. Every day, he shows up and offers to either buy your share of the business or sell you his.
Okay.
But here's the thing. Mr. Market is, let's say, moody. Some days he's wildly optimistic, quoting a ridiculously high price. Other days he's incredibly depressed and offers you a price that's way too low.
Sounds like the actual market.
Exactly. That's the point. He is the market personified. And the intelligent investor, Graham says, doesn't get swayed by Mr. Market's daily mood swings.
You don't just follow him blindly.
No, you're free to ignore him completely. Or even better, you take advantage of him. When he's pessimistic and offering you a bargain price, maybe you buy. When he's euphoric and offering a crazy high price, maybe you sell to him.
So it's about using his irrationality to your advantage.
Precisely. It's a powerful lesson in emotional discipline, in independent thinking. Don't let the market's noise dictate your actions. Judge the value yourself.
Which brings us back to why this 1949 book is still such a big deal. Why do giants like Buffett still talk about it constantly?
Well, like we said earlier, it's because human nature, greed, fear, the tendency to follow the herd hasn't changed. And the basic principles of business valuation haven't either.
Mm.
The market environment changes, sure, technology changes, but the fundamentals Graham focused on, they endure. That's why people like Buffett and Charlie Munger built their entire careers on these foundational ideas. They just applied them relentlessly.
So wrapping up, the intelligent investor. It feels like it's about way more than just picking stocks.
Oh, absolutely. It's really a manual for rational thinking in the face of uncertainty and, frankly, chaos sometimes. It teaches you long-term perspective.
Yeah.
It helps you draw that crucial line between investing, which is based on analysis, and speculation, which is often based on hope or emotion. Separating logic from feeling.
That sounds about right.
And, Buffett summed it up perfectly. He said, to invest successfully over a lifetime does not require a stratospheric IQ. What's needed is a sound intellectual framework. And Graham's book provides exactly that.
A sound intellectual framework.
Exactly. So maybe the final thought for you listening is, how can you apply that kind of sound intellectual framework, not just to money, but to how you assess information, how you make decisions in other parts of your life? Where might your Mr. Market be trying to sway you with irrational noise?